Brendan Chapman with you today. It's another edition of Theo Night Video for Monday, October 10th, 2022. The title of today's session is Defense Stocks Pop, Gold Drops, and Petitioning for a Redo, or maybe you could call it a do-over. It's kind of crazy. You got all these people out there, money managers, Cathie Wood, you got the UN, all these money managers and those politically involved that are suggesting that central banks around the world should hold off from raising interest rates. And again, I find it interesting that, they just want to go back to the way things were. And the only problem is the way things were not really benefiting everyone generally. And we're feeling the hangover effects as we speak, as the market's continuing to see declines. Today was no exception. I mean, there was that brief kind of rally intraday today, as Brainerd said some dovish news. There is escalation in terms of conflict with Ukraine, who did what to who and when. Obviously, defense stocks are starting to see some momentum as a result. As you look at the S&P 100 today, Walgreen Boot Alliance caught a bit of a bid right ahead of its earnings announcement. You've got Merck, you've got some staples like Kraft Heinz Corporation. You got Exelon, which is a utilities company. We'll look at there. Altria, very defensive. So you'll see that Staples really kind of led out today, followed by industrials, materials, and utilities. Energy was the area that was down the most today. In my Friday session, of course, we've been bullish on energy going back to the previous week. Last Monday, we talked about some energy opportunities as well in this session. But on Friday, we talked about the idea of taking profits here because of a near-term potential pullback. Things were pretty overbought. The expected move, things were extended. So it made sense we'd start to see a little bit of a coming back in of energy, the sector, and utilities. It looked like it was starting to form support last week, and then it just broke down. That was a sector we also talked about in last Monday's video, as well as maybe potentially being bullish. And we're going to talk about a potential trade on this that Don sent out today to our subscribers, an alert rather, that, kind of plays the bullish side without being too bullish. Okay. All right. So as we circle back to the S&P, let's bring up the SPY here. We're at support. If you look at the VIX moved higher today. We're approaching that 35 territory, which is more resistance on the VIX, which generally corresponds with support in the S&P 500. As we look at this from a different angle, 3-month VIX to 30-day VIX, this is around 1.00 right now. So again, a value below 1 is indicative of expectations that volatility is going to fall in the near future, which means that's generally bullish, especially if you can see this coupled with VIX backwardation. And this is the from a contract here. So we are seeing prices decline. Expectations are that volatility is going to decrease in the near future. The biggest wrinkle here for the market is, of course, we do have bank earnings kicking off on Wednesday. And things like net interest margin, net interest income, bond trading revenue, those are big things. But probably the biggest that I want to look at is how much are they setting aside in terms of the potential for defaults, loan loss reserves. That could be the one outlier that could see earnings decline significantly against expectations for a company like JP Morgan, of which their CEO announced today, hey, the S&P may have more than 20% more downside to go. Go figure, right? 20%, is that really where we're stopping? That would put you right around what, 2,900? The reality is 20% is easy to say, and what he's saying is you may want to reallocate here, folks. If he said 2,000, people have thought he's crazy, even though it's 2,000 in the sights of the market. Given the climate that we're in right now, it may not be out there to say that 1,500 to 2,000 may be where the market ends up going. And if we measure the retracement, 2,200 gets you back to a 61% retracement. Could we retest the highs from 2000 and 2007 rather? Absolutely, that's a possibility. Everything hinges on how strong the dollar is going to get. If we look at the bond market today, TNX, 10-year treasury yields, were inching higher. which is interesting that utilities were higher today as well. I guess really kind of just flat. But again, we're seeing yields move higher in the expectation the Fed's going to raise rates. And right now it's about an 80% probability the Fed raises 0.75 of a point coming up in their next meeting on November 2nd. So if you want to see that, you can bring up the CME, the Fed probability tool. Look here at November, and we're talking dipped a little bit to 78% from 80% earlier in the day. So the point being is it's very certain that we're going to end up moving higher. And not only that, as you go to December, there's been a bit of a shift towards the 4.5% territory. 28%, it was 23 and 0% a week ago. The thought that the Fed might raise 75 in the next meeting and in December's meeting. The Fed is not exactly abating here, right, from their trajectory of higher interest rates, which is creating stress. Now, at the same time, they're out there providing liquidity in the reverse repo market and doing other things. Just like the Bank of England, right? The gilt market struggled today. They're still buying gilts, by the way, and they're planning on until like the October 17th or something for another week. At the same time, they're saying, hey, we're going to raise rates to kill inflation. Well, why are you talking out of both sides of your mouth? Go figure, right? Of course, Kathy Wood and the ARK funds are a little worried, right? I'm like, they top ticked the market a little bit before, back here in November, October, before they came crashing down. I'm not sure they're exactly defining a bottom yet. We're not seeing this kind of great rotation back to more cyclical names like Apple. Look at Nvidia as another example. We talk about bearish trade here. Nvidia breaking support, or Nvidia. Look at MU Micron, right? We're rolling over today as we kind of continuing the move we saw last Friday. AMD. Again, this is not looking pretty for these stocks, and of course FedEx. FedEx, pre-announces and it was bad, and it's potentially getting worse as this train wreck continues. And the reality is the consumer is chapped. The consumer credit is expanding dramatically. The cost of that credit's expanding as the Fed continues to raise rates. And it seems like, 4.5% certainly seems very, very plausible, maybe even before the end of the year, which nobody would have thought of. Well, I guess people have thought of it at various stages, but not for very long before they quickly reversed and thought pivot again. It's a tough one, but for defense stocks like Northrop Grumman, they broke out today. What about Lockheed Martin? Lockheed Martin is seeing a breakout today, although fading from the intraday highs. Point being is that defense stocks can create a little bit of near-term opportunity. They would benefit by increased defense spending and production of the defense type goods. So it is one to kind of keep an eye on. As the things escalate, could we see maybe a little rotation at General Electric? Not exactly as direct. Boeing, a little more of a secondary here as well. But the idea is the periphery of defense may see relative strength in the near term. But one that could really surprise us if yields start to ease back is utilities. And today for utilities, we're going to look at a trade that Don suggests. So the idea being is that I thought we were starting to form support last week. That broke and kind of retested our lows again. We're seeing that happen again today. But you don't have to necessarily take a directional trade here. You can do a little bit more of a non-directional trade where you can either see it go down or go up dramatically. If it languishes here, you may close it for a small loss. This is what's called a call ratio back spread. And for this trade, again, this alert that went out to our clients today. So I'll give you kind of an example here. Don closed one on Intel last Friday. No, it's closed today. Sorry, look at the wrong thing here. Closed that one last Friday for 45% profit on the risk. But anyway, so as we look at this is looking at an 18 November. So we're out here a little ways, 39 days. We're trying to kind of prohibit that valley of death that's centering around our spread trade, the spread price here. But what you're going to do is you would actually sell the 63, which has moved up a little bit. It's at the money it currently. You can maybe push out to 64 if you wanted now from where it was earlier in the day. But what you do is you sell that one. And then you look at this, you say, I got about $3 in credit here. Well, what could I buy for $3 credit? And you come out here and you say, well, I could buy 2 of those. And the idea being is that you're creating a trade. If I were to analyze it here and go to the risk profile, you're creating a trade that is bullish in nature. You'll notice this is the valley of death. It's realized, so you're not going to hold it to expiration. But you'll notice there's very little risk here. If the market declines, you got currently about an 87-cent credit. So you make $87 at expiration if we expire out of the money. But if things go up, you do, in theory, have unlimited upside. All you got to watch out for is that if nothing happens, right, we don't get above 67, that's your valley of death, and things kind of sink in here as we approach expiration, in the coming couple of weeks. But you've got plenty of time here for this thing to kind of settle in. There's a little bit of risk if volatility does drop around the 67 strike, but if we can move higher, you do have upside here. And looking at actually in the past, a move to 67 would not be unreasonable, and frequently these rallies off support can be pretty furious. So if we fall into the abyss, great. If we hang out, you might lose a little bit. If we see a big rally, you could see a potential significant gain there on the risk. So I think that one's kind of an interesting trade that Don sent out, or an alert that Don sent out today to our subscribers. But as we circle back, things like XLP, which was the top performer today. Interestingly enough, that was not the trade that we saw on XLP today. For XLP, it was actually a roll out in November, rolling it from another expiration. We can look down at time and sales down here, but the time and sales data for today, should have wrote down the actual roll, but clear all the filters out. You'll see we rolled it from a 21 oct 70.65 to a 65.60. So again, keeping some on the table here, but again, opening up the possibility of 60. Realize this, that despite the fact we were higher today, again, the market is weak and there's a lot of risks out there that could present itself. This is a downside trade that didn't really cost a whole lot, that has significant reward to risk. And certainly, could we get to 60 by November if we see a further sell-off in October? Sure. If we see a bounce in the short term and then a breakdown, sure. It's a spread trade, and you've got till November with a break even that's maybe around what, 64? Okay, so not necessarily a terrible thought as far as taking a bearish trade on XLP. But again, you might look to see if we do catch a rally here, and if we can rally back towards 69, that might create an even better setup. PayPal, of course, if you heard some of their potential policy changes, a lot of people are drawing their funds or canceling PayPal. Stock was down 6% today. You saw the option trade come in as well on PayPal. This is what for a weekly option in here at the, I believe it was the 85 strike, mostly bought here. Now this has moved at the money, slightly in the money. Again, you see more interest stepping in here and out here and down here. Again, as PayPal maybe push things a little too far in terms of the wokeness, maybe, right? And people may be responding, right, with their feet, or rather with their money, maybe looking at other sources or other means to do payment transfers and purchases, etc. And again, we may be looking at near-term support, retesting that kind of $70 mark down here from June and July. Now, again, weekly data, sometimes it gets reversed, but again, we were seeing, 85 is kind of a trigger point. We broke through it. We could see an acceleration in this down move here in the coming week, in particular if things come out pretty negative with regards to banks. Obviously, they're not keeping balances, but, well, it's kind of they are, because they do have their banking side too. All right, let's look at HYG. So you think about bonds. HYG down big. This is one that I kind of hit a lot last week for unusual option activity for our clients on TheoTrade. But again, big down move today in HYG. But the realities of HYG and real estate for that matter, it certainly looks like there's more potential for downside in these products. And sometimes, you're in the hole right now. It's tough to short in the hole. But out of the money spreads are one way to speculate. Again, going 4 days is a little short. You could give yourself a little bit more time, but the skew generally is favorable for these types of trades into the hole like this. But in this case, we had a 14-oct 7150 here, and then a 7050 there. So you notice again, the volume is greater than the open interest. These are opening transactions. 70.5 is here. So again, we start to take that out. Again, we may continue to drive down even further. There was a 71 put that was bought in here as well. So again, a lot of interest here. We may see a continuation, and downside spreads are one way to get into a oversold condition, expecting to get further oversold. You could come out here like a 71.70, cost you, a little over a 40, a little less than 40 cents there for a $1 spread, or even spread it out to like 69. And again, if we get to 69 by next week, that's a decent reward to risk for that kind of trade. FCX, despite the fact that, again, we're seeing issues. Gold today was down big as the dollar is strengthening. We can look at the euro/US dollar. Again, this was dollar strong today. Silver was down as well, but in the stock trade, FCX also had a bearish trade today. Looking at continuation, was higher, but sometimes you see it selling into the strength. And in this case, for FCX, it was a February expiration, so it's out there a little ways out here at the 27 strike. So again, what are we saying? That yeah, we may see a little bit of short-term bounce, but expectations are the dollar continues to strengthen as the Fed raises rates, and we're looking for a value in FCX below 27. So while it's holding up relatively well, we've got earnings and a whole lot of time here for FCX to trade at significantly lower prices. On the flip side, though, stocks like AG, this is First Majestic Silver. So again, not pulling back as much, down 0.36% today at kind of a support level near 8. This was a bullish trade that was put on for out here for October. Again, not a huge trade out here, but the 950 strike, you'd probably want to see a bit of a trigger, maybe trading through 850 here to help kind of prop this up. Looking for a bounce, maybe an 860 as a trigger. Maybe have a chance of rolling towards 10 here in the near term if the dollar weakens. So again, there's a lot of uncertainty. What is the dollar going to do in the bigger picture? It's going to strengthen, but in the near term, you could see a short-term reversal. That's what this is kind of playing here. Finally, BX and PMT. BX, this is again, owns a lot of homes, rentals, etc. Broke down. This is one we looked at last week as a bearish trade in BX. That trade got rolled today. And this one was, man, it's for a December expiration, but this one got rolled and it was down here at the December, look at my notes here, 85.70. So look right here, 85.70. Downside put spread. Again, how do you shorten the hole? Generally speaking, by doing a spread trade, buying 51, selling 59, and looking at a $70 strike price down here. Blackstone looks like we may get there. We have earnings coming up as well. And finally, PMT. This is PennyMac Mortgage Investor Trust. So again, breaking down, more talking mortgages. Again, you think about AGNC, you think about NLY. These are NLY had several bearish trades early last week. PMT is just kind of a continuation in that kind of bearish environment. And for PMT, it was the Jan expiration out here at the $10 strike price right there. So not far out of the money, but $1.25. That's still over 10%. Again, we may fast get there given the climate we're in and the chaos that's happening in the bond market. Well, folks, I got to wrap it up there. Again, I hope you're able to find some ideas from this video. We'll catch you back next week. Thank you.